Another really ugly day in the market as we close near the lows, especially because there was pretty good reasoning for us to get some strength in the second half after the early morning washout in Nvidia. The fact the stock came back, and then also the fact that inflation has been one of the few positive parts of the narrative. It's really been the core of the bullish narrative behind the Russell, behind the cyclical stuff. That's been about inflation cooling off in a good way. So tomorrow, with inflation, the only thing on the calendar, we don't have big tech earnings for a week. Big tech's been the problem. We could have easily seen the market firm up in hopes that tomorrow we get evidence that's positive for the economy and we could ramp it up into the weekend. So the fact that nobody took that opportunity and that there was selling again into the close, the red light stays on stocks, the green light's still on bonds. Even though yields have been creeping higher, I'm not changing really anything on the macro yet because for the most part, the macro is pretty locked in. It looks like the economy is weakening, and it looks like we're going to be cutting in September. Now, two important things here, two charts to think about going into tomorrow, because there's a real tough question right now of whether or not the market will take soft PCE. If we get a number that's light tomorrow, is it going to be good? Keep in mind, is it good for stocks? Some. Keep in mind the last entire 2-week event, this massive rotation, was spurred on by the light CPI. And yeah, it's been great for regional banks. It's been great for home builders. It's been great for a bunch of stuff. But it's been bad for the market as a whole because of the tech rotation. So since July 10th, the CPI print that came in light, the Magnificent Seven's down in full-on correction mode. And that's why, because when this spread is negative for tech relative to the other stuff, it adds up negative for the index. That's been my whole point and the reason why I dropped the green light on stocks the day that inflation hit. So now look at what's happening in bonds. This is where you get a very difficult question right now. And for the most part, it looks like the answer to the question is basically that the economy is softening, okay? There's been a creep in unemployment for a reason. But what's happening in the 10s to the 2s now, the 10s to 2s spread is basically uninverting. That's because the market's pretty sure the cuts are coming. So this whole rotation that's taken place since a light inflation print, which has been negative for the S&P 500, why then would a light print tomorrow suddenly be positive? It's a difficult thing to picture right now unless the tech bleeding stops. So you have to get tech to stop selling off, because even though the market's taken light inflation prints and made it positive for small caps, made it positive for the regionals, made it positive for this cyclical stuff, there's still a very dicey logic behind that, because the uninversion of the yield curve, if it happens, that's the traditional end of the cycle. You get the inversion that starts the slowdown, and then the uninversion when the actual timeline for recession is very near. So that's where this becomes a very difficult game of trying to pivot so hard into cyclical stuff that depends on the economy. But it gives us some sliver of hope that if the inflation print comes in light tomorrow, maybe we'll get enough strength in the trade that's been working, the rotation winners, and maybe just a slowdown of the selling in the rotation losers, which have been tech. Bulls desperately need something good to happen tomorrow, because today was, again, ugly.